Hello, Dan Passarelli here. How are you feeling today? Glad to be here with you. I want to make sure you can hear me. Please go and hit that box and let me know that you can hear me, please. Give me a big old hello. I'm talking lots of O's to end that, guys and gals. All right, Justin. Fine. Juan, my man Larry, and David. Oh, we got the whole family here today. Mark is here. Oh boy. Okay. Who else? Who am I missing? I've got everybody here. All right. That's what I like to see. That's what I like to hear. That's just, plain old what I like. I just like it. I like it. I like it a lot. Now, today we're going to be talking about volatility, term structure, and skew. These are super important things. And they're this kind of things that fly under the radar, you know? Like, they're like the windshield washer fluid in your car, you know? Like, you got a gas gauge, you got a temperature gauge, you got a speedometer. If you got a stick shift, you might have a tachometer that you care about. Nobody has a stick shift though, right? Who has a stick shift? Nobody has a stick shift. But if you don't have any windshield washer fluid in your car, you can run into some serious trouble sometimes. You got to be able to check it. You got to be able to know what's there. It is one of those things, but it's one that a lot of people don't really pay that much attention to. Well, I don't know if that's a perfect analogy or not, but it's a little bit like volatility, term structure, and skew. It's important stuff. It's not as important as running out of gas or speedometer or, make sure your brakes work. But without it, you're going to be in trouble. All right. That being said, before we get started, I need to point out options are not for everyone, and you should read characteristics and risks of standardized options. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your particular situation. So use a little common sense here, folks, and know that what I'm trying to do here is help you and not tell you what to do. I want to empower you to make your own decisions, and good ones at that. I want you to be successful. Now, I see some familiar friends here, some market taker / Firstrade family members, but I see some new names I don't recognize here. So you might not recognize me. You might not know Dan Passarelli from Adam. So allow myself to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular options trading books. I'm a little more than halfway through my third, and I've been part of a few other books, had some sections in some other books. Write on Substack, do a daily video. What else do I do? I've written a gazillion articles, been quoted in the press. You know, I contribute content in the options world. And I'm able to do that because I've been a trader for over 30 years. Oh my gosh, I'm old. Holy cow. Uh, but hey, you know what? I'm embracing this phase of my life and career because it's kind of cool being the old guy with all the experience to be able to help the newer generations or even the older generations who are, new to this. So I traded down on the floor of the Chicago Board Options Exchange as a professional trader. And now I trade in a regular old retail trading account, just like you. And I am the founder and president, CEO of Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries. Do you believe that? Isn't that crazy? It's students in over 50 countries, literally trained tens of thousands of students, um, and counting the ones that I do that are free. That number is well into the six figures, into the hundred thousands. That's a lot. That is really a lot. And I am a trading industry collaborator. I work with all the options exchanges in the world. I've had some sort of interaction with all the options exchanges in the world. Um, Definitely in an advisory or helping capacity for most of them, and also work with all the top options trading brokerages, like, for example, Firstrade. And I'm a family man. I have my wife, Kathleen, who those of you who are our student traders know because she runs operations here at Market Taker. And I have my two adult children who are just about to be moving in together. Do you believe that? They because of their school situations, they're both here right now, but they're moving out in a couple of days. That's pretty exciting for them. And it's nice that they're moving in together, isn't it? It's kind of cool. They're still both in school. And finally, I do other things for fun besides trading or in addition to trading. I'm a runner, foodie, traveler, just got back from Nevada last night. And I'm a music person too. I enjoy music of pretty much all kinds. I wouldn't say I love music of all kinds. That would be, you know, I mean, I could say that, but, you know, I'm a music person. Let's just leave it at that. Now, I have one single objective today. That is to make you a better trader. And what we're going to talk about here today in terms of volatility, skew, and pricing and all that is going to help a lot. But you know what else is going to help you a lot? If you go to markettaker.com, which is up here, two T's in a row, market as in stock market, taker as in take what is rightfully yours, markettaker.com. And then just go all the way to the top right here to join free. And we've got more classes and more help. And you'll be on our weekly free newsletter list. You'll get invited to more free online trainings. There's a lot of benefits to join free. Okay. So in order to begin this concept, I guess, we need to understand options pricing models and volatility. So here's the deal. Options have been around for millennia. Not listed options, but the concept of options. One of the first options in recorded history was way back in ancient Greece. There was a gentleman. I think he was a gentleman. I don't know. He could have been a real jerk for all I know, but his name was Thales, a Greek person. And Thales was, one of these philosopher Greek guys who, they were all like doing all this smart stuff. And one of the things he did was, he would forecast the weather and he got his hands in business sometimes. And he predicted a bumper crop in olives. Bumper crop meaning like it's going to be a crap ton of olives. Weather conditions he thought were going to be perfect. How do these guys like 2,000 years ago or whatever it was know how to do that? How do they know? Well, let's see. The Greeks they were BC, right? So more than 2,000 years ago. How did they know how to predict the weather? They thought the world was flat still back then, right? But anyway, he predicted a bumper crop in olives. So what he did is, and I don't know if you know this, but certain agriculture communities, like wine growing communities and apparently olive orchards and stuff, they would be kind of communal. Like one person couldn't afford to buy like an olive press. It's kind of like how that works with hospitals now, right? Like there's not an MRI machine in every doctor's office. There's one, and like different clinics and stuff, they send them all to the one place because they can only afford one. That's what it was like back then. So there was like just that small handful of olive presses in the region. And so Thales went to all the olive presses and he said, look, I'll give you X number of drachma or whatever. I don't know what the currency was way back then. X number of drachma, for example, to have basically the right of refusal. If I want to use the olive presses, I'm going to have, this is basically a call option. I have the right to use the olive presses above and beyond anybody else for this time period. So that's an option. And he was right, and he owned the presses and made a crap ton of money. You didn't know these philosopher types were like pretty savvy businessmen too, right? But they were. So anyway, options have been around for a long, long time. There's other examples between then and now. But in 1973, options were listed on an exchange for the first time ever. That exchange is the Chicago Board Options Exchange, which a lot of people don't pronounce correctly. It's the Chicago Board of Options Exchange, which doesn't make any sense, but it sounds really weird saying it the right way. Chicago Board Options Exchange. Why is it called that? Because it's the Chicago Board of Trade spun it off. I mean, it was actually a subsidiary of it for a long time, and then they eventually spun it off. So that was in 1973. But the question is why? Because anything that ever happens in history, there's always a reason for it. And sometimes it's an unexpected reason. And the reason why options were able to be listed in 1973 had a whole lot to do with a couple of guys from Chicago, Fisher Black and Myron Scholes, who put together the first options pricing model. Arguably, there were people who tried it before, but never could really get it. I'll tell you why in a second. And on top of that, there is some speculation that there might have been a guy right around the same time, but a little bit before Black and Scholes, who created a working options pricing model, which was actually very, very similar, by the name of Edward Thorpe, also famous for writing the book Beat the Dealer, for all you gambling people out there. But Fisher Black and Myron Scholes get the credit for it. So they created the first options pricing model in 1973. And it was specifically for non-dividend paying European call options, but it adapted into other models that take care of dividends and puts and American exercise, the whole shebang. So they created this model and people worked on it before then, but the question was always like, it's a piece of math, and you know how math works, right? There's like all the inputs into the equation and then an equal sign and then an answer. Well, they knew a lot of the inputs. Like obviously the stock price would matter for the option price. Each strike price would matter. Clearly the amount of time until expiration would matter. That's very intuitive. Would you rather own the right to buy the stock at 100 for the next 90 seconds or the next 90 months? Obviously, there's more value the more time in an option contract. Interest rates, expected dividend stream, that came later. But what they didn't really understand was this one extra input. There was something else there, and they couldn't figure out what it was and why it was. And that was the genius of Fisher Black and Myron Scholes that they got credit for, was the input is volatility. So volatility is the economic rationale for option trading. Because look, like the SEC, right? The SEC, like, they don't want you getting ripped off by people. They don't want you trading, so far, they don't want you trading futures on like football games. Who knows? That might come in the moral decline of America. Not that I'm opposed to it, but there's not a whole lot of, arguably not a whole lot of economic purpose to it. But the SEC and FINRA, they allow option trading because there's a reason for it. Because investors can hedge their stocks. They can protect themselves against, drum roll please. We got any drummers in the house? Anybody, any drummers in the audience? Anybody? No. Going once, going twice? No? Okay, good. We can tell drummer jokes then. I forgot all my drummer jokes. I used to know drummer jokes when I played with a band, but Larry, you're a bass player? Did I know that? I forget if you told me that before. Me too. Got my Rick right over here. I got a P bass laying around here somewhere. How about that? I did not know that, or at least I did not remember that. That's pretty cool, man. Okay, so okay, so drum roll, please. The thing that they added was volatility. And so volatility is a misunderstood concept. There are two general categories of volatility when it comes to option traders. There's historical volatility, which we also call realized volatility. Those two words are synonymous, and I will use them interchangeably. And then there's implied volatility, and both are stated in the units of annualized standard deviation. Now, you really don't need to know what that means. If you're interested, look it up. Basically, what they do, well, here, let's do this. Basically, what they do with historical volatility, HV, also called realized volatility again, is skip down to the middle bullet point. They take the last 30 calendar days of trading prices, well, or the last 30 days of trading prices. And what they do is they find the standard deviation. And the standard deviation of the last 30 days, they take that and they annualize it, which basically says, okay, if this is what it's been for the last 30 days, if over a whole year period, that's what the standard deviation was, it would be this. So they make the last 30 days representative of a 1 year period. And like I said, if you are not familiar with standard deviation and you're very interested and you want to learn more about it, JFGI, check it out. And if not, then that's cool too. All you really need to know is its units. Sort of like on your radio station. Like you turn the dial and it's a number of hertz, right? What's a hertz? Doesn't matter. But that's what unit it is. So that's what it's like for annualized standard deviation. Now, here's the deal though. What annualized standard deviation does is, because it takes the strike prices, what it really does is it finds an average price, a mean, and maybe a median also, which are going to be different because we use a log normal distribution. And then they find out if here are all the prices plotted out, a lot of small moves and some big moves, higher and lower, find the mean. And then standard deviation is the standardized deviation from that mean. So HV, notice I didn't mention the word options in that whole conversation, did I? It's just a measure of how volatile, how big the deviations were from the mean of the stock price. But implied volatility, that's the darn tricky one. It's a tricky one. What they do with implied volatility is they make the assumption, and by the way, I hate that it's called implied volatility. If I were king, which I'm not, I wish I was, everybody wants to rule the world. If I were king, I would have called this something different than implied volatility, because it makes the assumption, wrongly so in my opinion, that the reason people trade options is predicated on their expectations for future volatility. Now, when I say wrongly so, you know, the best lies are rooted in truth, right? Anybody who is alive in this era of history and is a thinking person sees that every day in the freaking news, right? The best lies are rooted in truth. And so that's what it's like with implied volatility. Do option traders make trading decisions based on their expectations for future volatility? I mean, what is your expectation for the future volatility of the S&P 500? Give that number to me in annualized standard deviation. Do it right now. There's a bunch of people scratching their heads saying, "Oh, I don't know. What are you talking about? That's blah, 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 blah." Right? That's what a lot of people are saying right now. But you kind of still make your option trading decisions based on your expectations for future volatility. I mean, look, if you own a stock and you're afraid that volatility is going to be high in the future, it kind of behooves you to hedge it, to buy puts to protect yourselves. But if you own a stock and you think the market is just going to slowly kind of climb up a tiny bit or move a little bit sideways and it's going to be really boring, you're not going to buy a put that decays in value every day. You'd be kind of foolish to do that on a stock you don't expect volatility for. And even if you're not a hedger, if you think a stock is going to go up, you could buy a call. But if you think that going up is going to be just a slow, steady grind and you buy a call, you're probably going to lose money because of the time decay, right? If you're going to buy a call, you expect the stock to go up fast, have some volatility to it. If you think a stock's going to be pretty boring, you sell covered calls or cash secured puts or credit spreads or you buy time spreads. So there is some relationship, but really what it is it's a measure of supply and demand. When Goldman Sachs comes in and buys 10,000 calls in some stock, what do you think happens to the price of those calls? They go up. Or if they buy puts, what happens? They go up. What happens if Goldman Sachs comes in and sells 10,000 calls? Price goes down. And all the options, calls and puts, they're the same thing. They're related. A put's a call's a put. It's what a guy I used to work for used to say. That's because of a thing called put call parity. If I own a call, that's basically the same thing of owning the same strike and expiration put and the stock. If you draw the profit and loss hockey stick diagrams, they're going to look exactly the same, and you're going to have just about the same risk and just about the same reward. They're synthetically related. A call and a put with the same expiration and strike have comparable time values and Greeks. And so if a big firm buys a bunch of this one type of call, the puts of the same strike are going to go up just as much as the call does because they're synthetically the same. And the calls and puts next to that strike are going to go up. And next to that strike are going to go up. Maybe even different expirations. You even see that with the meme stocks. I just did a bunch of free workshops with Market Taker. Those of you who watched my last presentation, you saw that. I did one on short squeezes, which is, kind of the new, it's meme stock 2.0 is what they call it in the media. You see that there too, right? When even if it's not Goldman Sachs buying, if it's a bunch of retail people buying a whole ton of calls and they're all buying the same calls because they're all on the same Reddit thread, price of those calls go up and they get more expensive. Which kind of brings us to our next thing here, skew. What is skew? Skew is the observation that different options on the same underlying stock can be assigned different volatility values. Because options on the same underlying can have a similar functional utility, volatilities tend to be related. And so I want to show you something here, friends. Let's take a look at what that looks like. Oh, I forgot about the two, what do they call that? Two, where they got to send you a text. There it is. It always takes just a second, you know? Okay. So let's take a little look-see here, right? Oops, that's not it. Where'd it go? There it is. So we go to options and we type in like SPY, get option chain. And then we go to Greeks and analytical. And we'll pull up, how about August 12th? It's 12 days away. Oh, I miscalculated. I just got back from traveling, so I kind of forget what day it is a little bit. Okay. So IV stands for implied volatility. If we look at these options in SPY for the August 15th expiration, for those of you who are watching this live, that has 15 days. These are the strike prices. We see the 632 strike has a 12.91 volatility. And then they get basically a little lower as we go up. I mean, it's not exact, but it's, you know, that's kind of the trend, if you will. And this one is 11.98. 1 point lower. 10 strikes higher, 1 volatility point lower. There's different volatilities for the different strike prices. This is very common, and it's particularly common for the higher the strike, the lower the volatility. Option traders tend to trade out of the money. So when I say higher strike, like strike above where the stock or ETF is, we care about the calls in white. When it's a lower strike, strike below where the, in this case, ETF is, we trade the out of the money, so it's typically the puts. The downside puts have higher volatilities the lower the strike. The upside calls have lower volatility the higher the strike. Call that an inverse relationship, right? So why is that? Why is that? Well, because what is implied volatility? It's the supply and demand aspect of the stock price, right? Or no, not of the stock price. It's the It's the supply. Oh, I lost it. Where'd it go? It's the supply and demand aspect of each individual option. So I guess what we can infer from this, if you think about it, people are more interested in buying lower strike puts and more interested in selling higher strike calls. Now, that's all in relative terms, relative to each other. But do you think that that would be a fair assessment? That because the implied volatility of lower strike puts is higher and the implied volatility of higher strike calls is lower, would that be a fair assessment that people are more likely to buy lower strike puts and sell higher strike calls? You think that's a fair assessment? I would say Well, the answer is yes, it is. But that's weird. Why is that? Why would that be? Because think about why people trade options. Why do people buy puts? To protect stocks. They trade puts based on fear, right? They fear volatility to the downside. And that could even be just people buying puts because they think it's going down. If you look at how stocks typically trade, there's a saying, up the stairs and out the window. Stocks tend to, grind higher, but when they fall, they tend to really fall faster. Slower moves up and they have rounded tops, faster moves down and sharp bottoms. So people are more likely to buy puts than calls. People sell calls as part of covered calls. For those of you who are covered call traders, hopefully you build my, or you're part of my, hopefully you listen to my podcast, Wealth Building with Options, which is all about covered calls and cash secured puts. People are much more apt to sell calls because of greed. They know that stocks tend to grind higher, and so they're less likely to have violent moves to the upside. And so they sell calls to make more money on those stocks that are going sideways or grinding up slowly. And so we get this demand for lower strike puts, supply of higher strike calls, and it skews the volatility. That's why we call it skew, BTW. All right. So that's what we're talking about here. But here, wait, let's go back here a second. But you look at this here, and it's not like this one is 100 and this one is 3 and this one is 72 and this one is 15. I mean, they're all in the same ballpark. And why is that? Well, because look, I mean, if somebody's going to buy puts, if you buy the 635 puts or the 634 puts, does it really matter that much? I mean, it matters a little bit, but it doesn't matter massively, drastically. You could buy either of them. They're somewhat interchangeable. So we tend to see a smooth, um, just like smooth data here, methodical. So what we just described is vertical skew. That's the observation. Vertical skew is the observation of varied volatility values among the different strike prices within the same expiration. But then there's a different kind of skew too. Term structure of volatility, which is also called horizontal skew. That's the observation of varied volatility values among different expirations of options sharing the same strike on the same underlying, obviously. So, okay, recap of vertical skew. Then we'll talk about term structure. Guys, I'm sorry. I know I'm going deep and giving you lots of good information here. I'm a little sleepy. I didn't get home too late, but it was a long, arduous trip. Okay, so typical equity option vertical skew, successfully higher strikes or successfully lower strikes puts tend to have higher IV than higher strikes calls, right? That's what I just covered. That's true for many, but not all stocks and indexes. Those of you who are trading my short squeeze system, those short squeeze candidates are the meme 2.0 stocks. the higher strikes actually have higher implied volatility. That's why, like, I'm talking about this stuff, and some people are like, I don't really care about skew, Dan. You know, I'm just gonna buy calls if I think the stock's going up. You can do that, but you're gonna have a harder time making money than the people who pay attention to it. The question is, you want to have an easier time making money or a harder time making money? Easier time. So you really need to pay attention to this skew. Yeah, those of you who are trading options rater, my short squeeze system, those stocks, the higher straight calls have higher volatilities. And you got to know why. It's because there's a bunch of retail traders all on the same Reddit channel, and they're all buying the same calls all at the same time. That drives the price of those calls higher. And are they buying puts? No, because they all think there's going to be a major short squeeze, which tends to become a self-fulfilling prophecy. That's why the skew is so, so important. Now, that's how it is for equity and index options. But different commodities are different. Like oil. Uh, what else? Grains. There might be a skew to the upside. Where's the fear? Where's the fear for corn prices? Well, I mean, if it goes up a lot, that's pretty scary for um, food processing companies, Kellogg and who else? Bungie, um, Iowa Grain, ADM, Archer Daniel Midland. All these people who have to buy, all these companies who have to buy crap tons of grain to make cereal and feed cattle and all that business. If they got to pay a whole bunch more money, that's bad. So the vertical skew tends, the higher price calls tend to be more expensive. So the shape of the skew for equity options, let's go back to that because I think that's what we all more commonly trade, can be steeper for puts than calls. We tend to see call implied volatility go down just a little bit with each higher strike, but puts tends to go up more and more and more. And it tends to be sort of exponential. Okay. It can be thought of as linear or curved, but it usually has some curvature to it and some exponential curvature to it. And it's accurate only in options with sufficient premium. If we're looking at options that are like the bid is 5 cents and the offer is $2, the implied volatilities are just going to be all messed up anyway. So there's no point even paying attention to them. So we need some pretty liquid options to really observe this. Now let's get into this, the term structure of volatility. This is super important. That is the observation that options with less time or more time to expiration with the same strike price tend to have different implied volatility. So if we go back to this, if we look at the August, here, let's look at Apple. Let's look at some that doesn't have dailies. So if we look at the August 8th, 15th, 22, 29th, and let's just look at the 210 calls. So the ones with 8 days have a 39.5% 0.19 volatility. The ones with 15 days have only a 33.6 volatility, so 6 points less. The ones with 22 days have a 31.25 volatility, so about 2.5 points less than the 15-day ones. 29-day ones have a 29.32 volatility, so about 2 points lower than the 22-day ones. So in Apple right now, the implied volatility tends to get lower and lower and lower as time passes. And that's sometimes the case. And sometimes the implied volatility gets a little bit higher as we go out further in time. But, it's usually a smooth type thing as well, because if I think a stock's going up and I buy the 22-day calls or the 29-day calls, does it matter that much? Maybe. It depends on my time horizon, right? But if I think it's going to go up over the next week, it doesn't really matter too much. It matters a little bit. The gamma is going to be different. Delta might be different depending on the strike price. But sometimes when we see that the short-term options have a much higher volatility, if it's a much higher volatility, that could mean that earnings is coming out, some sort of planned volatility event. Now, for those of you who are listening to this live, in less than 3 hours, we're going to have the Federal Reserve announcement. And so that's the reason why some of the shorter term options have higher volatilities in some stocks and S&P 500 right now. So there's a shape to that skew too, but it's kind of like a whip. Like the longer term options is where you hold the whip, the fat part, and the shorter term options are the tip of the whip. When implied volatility rises, it rises like this much in the back, but in the front of that whip, it's like this much, right? The short term options, it's like this much. So, okay, Dan, why do I care? I'm here to make money, not to hear interesting things. You're right. This is interesting, but we care about making money. So let's look at the practical uses of volatility and skew. So as far as the volatility component of a trade, volatility, like the other variable inputs into the options pricing model, is one individual component that leads to profit or loss on an option trade. You will make or lose money on volatility on every single one of your option trades, every one. So you could either let that be just a wild card thing that is going to happen, or it can go into your planning and you can try to make money on it instead of just being like, oh, maybe volatility will help me, maybe it'll hurt me. I don't know. Like, that's not a good attitude. So just as option traders consider the risk reward of a stock rising or falling, your delta, or time passing, your theta, you better care about the risk reward of volatility too, which is measured by your vega. And so, hold on a second here. And so, it's important to forecast volatility and the value of IV to try and get favorable value, to get an edge on your option trades. Think of implied volatility as the normalized price of an option if you hold all other factors constant, which is kind of a weird way to think about it if you never have before. But the best traders think about it this way on every single trade. The option traders who make money consistently, they're looking at volatility on every single trade. And they're thinking about it as the price of the option. Because sure, if the stock goes up or down, you'll make or lose money on your calls respectively, and vice versa on your puts. And as time passes, options lose value. So whether you're long or short them, you'll make or lose money. But how do I know if I'm getting a good value for this option? If I'm buying a put, how do I know that put's not overpriced? Let me ask you, has that ever happened to you? Have you ever bought a put to hedge a stock and the stock actually goes down and you still lose money on your put? And some of that, of course, is time decay, but some of that is implied volatility too. So we need to use a volatility chart, which just Google it, you'll find one online. And here's how it works. If you're buying options, the implied volatility in a volatility chart should be at the bottom half of the past 6-month range. Implied volatility should be below historical volatility. And IV and HV should be expected to stay stable or rise. And, I'm saying if you're buying options, it should be these things. I should probably state it the other way around. I should probably say, if bullet point 1, 2, 3, then buy options. If implied volatility is in the bottom half of the 6-month range, and if implied volatility is below historical, and if IV and HV is expected to stay stable or rise, then it's a good environment to buy options. If it's the opposite, you probably want to sell options. If implied volatility is in the top half of the 6-month range, and if implied volatility is above historical, and if implied and historical are expected to stay stable or fall, that's an environment when I should sell options. So what this really does, folks, is it drives which way to trade it you do. Because look, let's say you think that a stock is going to go up. Well, obviously you can buy the stock, but if you're an option trader, you want to do a little bit smarter, right? Option traders are smarter than non-option traders. So you could buy a call, or you could buy a call spread, or you could sell a put, or you could sell a put spread. There's a lot, and it's different strikes. There's a lot of different ways to trade options. If implied volatility is super high, like the second set of second level bullets, and you buy calls when implied volatility is super high, like the day before an earnings announcement. I mean, tell me if you ever did this. You ever, when you were newer to options, for those of you who are experienced, you ever buy calls the day before an earnings event because you thought the stock was going to go up, and you were right, the stock did go up, and your call still lost money? That ever happened to you? And that's when you curse somebody else. It's somebody else's fault. It's those market makers. They're ripping me off. I heard about how nasty they are. They have a picture of me down on the trading floor. They're out to get me. It's not the market makers. It's implied volatility. Implied volatility tends to go up as a volatility event like earnings approaches, and then smash right back down after the event. Never buy calls or puts going into an earnings event. I say never, pretty much never. There's sometimes when you would, but almost never. Because the implied volatility is going to get smashed. You got to plan your option strategy around volatility events and what volatility is doing. And so, I know I showed you a Firstrade option chain that shows this, but like this is the idea. We get skew, higher strikes, lower vol, lower strikes, higher vol. Horizontal skew or my term structure. This is an example where the volatility goes up, up, up as time to expiration increases, which is a little bit more normal. That's called a contango term structure, if you want to know all the fancy terms and stuff. What I showed you before in Apple is what is known as backwardation term structure, but it could be either. Anybody here trade time spreads or calendar spreads? If it's like this in contango, where if you're buying a time spread, you'd be buying a higher volatility than what you're selling. You're putting on a pretty unfavorable volatility term structure. You're putting on a trade for a negative edge. You only want to buy time spreads when the option you're selling has a higher implied volatility than the one you're buying. So, bottom line, volatility, term structure, and skew are important tools for option traders. They can potentially help a trader make better decisions on what option to buy or sell and whether I should be buying or selling. And they can add value to a trade in terms of edge. It's an extra thing that can give you an extra benefit. Like if me and you were going to run a race, 100-meter dash. Let's say, we both know pretty much how fast each other can run and we're pretty similar. But if I got a head start, I could start 10 meters in front of you. I probably have a better chance of winning. Or if you got to start 10 meters in front of me, you'd probably have a better chance of winning. That's what it's like with using volatility and term structure and skew. They don't make or break a trade, but they do make or break a trade. They give you that head start if you do it right. If you only buy options when they're cheap and only sell options when they're expensive, there's something besides looking at the chart patterns or the fundamentals or how much time to expiration there is. There's something else you're putting on your side. And that, friends, is super important. All right. Do we have any questions before we call it a day here? Any questions before we call it a day? No? All right. Then we call it a day. Oh, are what now? Those prices that we were just looking at? They're just, oh, are these, oh, I see. No. It's because I was traveling yesterday. I had to go visit my mother who was having a minor surgery. So I had to go out there and help. So I was traveling yesterday. But we're back on our regular Tuesday schedule next week, friends. Yeah, she's totally fine. Yeah, thank you, Justin. I appreciate that. All right. Have a great rest of your day. Catch you next time. Trade smart. Ciao. Bye. See you, Juan.